A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. Central banking. In banking systems consisting of more than one bank, a state-controlled central bank functions to transfer funds denominated in the state's currency between member banks. The central bank can be thought of as the operator of a spreadsheet, which includes a transactions account for each member bank, generally called a reserve account, that records balances generally called reserves. The central bank also keeps accounts for the Treasury and for foreign central banks. The central bank marks balances in the various accounts, up and down, credits and debits, on instructions from those entities with accounts. Furthermore, the state sets the operating procedures for the central bank and the centrals in the banking system, including regulations regarding overdrafts, negative balances, which are accounted for as loans from the central bank. The central bank itself neither has nor does not have funds. Rather, it acts as the scorekeeper for the members, crediting and debiting their accounts as per their instructions, and accounting for what it does with debits and credits in the central bank accounts, using a process generally referred to as double entry accounting. Central banks are, in general, public sector entities. They are created, regulated, and supervised by the state to serve public purpose, with all profits credited to the state. The state's central bank is the only source of reserves for that currency. Reserve balances are created when the central bank credits member reserve accounts. And as a monopolist, single supplier, of reserves to the banking system, the central bank is necessarily the price setter for two rates. The first is called the own rate, which is how that item exchanges for itself. For a currency, the own rate is called the interest rate. Credit balances in central bank accounts do not earn interest unless the central bank acts to pay interest on those balances, rendering the payment of interest a political decision, as evidenced by well-publicized meetings of central banks where the officers select their policy rates. In that sense, the natural rate of interest, the policy rate in the event that the central bank does not elect to pay interest on reserve balances or otherwise support a higher rate of interest, is 0%, with a higher rate possible only if supported by state intervention through its agent, the central bank. In practice, policy rates above 0% are supported by the central bank paying interest on reserves, or are the central bank maintaining additional accounts, called securities accounts, on behalf of the Treasury. Such accounts are more commonly known as Treasury bills, notes, and bonds. Securities accounts are interest-bearing alternatives to reserve accounts and function to support a term structure of rates above 0%. The rate of interest the central bank sets is called the policy rate, which is meant to function directly as the marginal cost of funds for its member banks, providing a benchmark for the rates banks charge on loans to their clients, which include a risk premium based on perceived creditworthiness. When the Treasury instructs the central bank to spend via crediting a member bank's account, the quantity of reserves in the banking system increases. Although banks can alter the distribution of bank reserves by interbank transactions, they are unable to control the overall quantity of reserves. Therefore, when the government net spends, deficit spends, the Fed funds rate will, in the absence of central bank intervention, fall to or remain at 0%. This explains why, in Japan for example, public debt that has exceeded 200% of GDP has not resulted in an increase in the level of the interest rate paid by the state. In fact, rates have remained near 0% for several decades, as directed by the central bank.